Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Cadre Holdings, trading under the ticker CDRE.
Yeah, and this is a really fascinating one to dig into.
It really is. Imagine you're looking at your portfolio right now, right? You pull up a stock you own, a company that makes non-discretionary, life-saving safety equipment.
The kind of gear police and militaries literally cannot operate without.
Exactly. But you see the stock chart, and between, late 2025 and mid-2026, the equity has just suffered this severe 35 to 40% drawdown.
Right, which is usually when panic sets in for a lot of people.
Oh, absolutely. Your instinct is to assume the core business is just collapsing. But what if I told you that the company is actually performing so incredibly well? It is triggering accounting penalties that make its official profits look worse on paper.
It sounds completely counterintuitive, I know, but this is exactly why you have to look under the hood with these kinds of structural plays.
Which is the whole mission of this deep dive today. We're going to explain to you how this transient valuation friction stuff like acquisition accounting, crazy foreign exchange volatility, and non-cash earnout remeasurements has basically temporarily obscured a massive operational inflection point.
Right, because at its core, Cadre is executing a highly profitable defensive growth strategy. They prioritize mission-critical safety equipment. We're talking body armor, explosive ordnance disposal suits.
Bomb suits, basically.
Yeah, bomb suits. But what really anchors their whole business model are these incredibly sticky government IDIQ contracts.
Okay, let's define that for anyone who isn't familiar. IDIQ stands for indefinite delivery, indefinite quantity, right?
Right. Think of an IDIQ like a master hunting license. The government essentially says, we pre-approve you to sell us up to this massive dollar amount of gear over the next 5 years.
So they have a guaranteed ceiling of demand.
Precisely. The demand is practically bulletproof.
No pun intended, right. But if the demand is so bulletproof, I have to ask about that 40% equity drawdown. If I'm an investor, a drop like that is terrifying.
It's the ultimate illusion of the financial markets, honestly. That temporary accounting dust created a narrative of distress. But if we wipe that dust away and look at the underlying mechanics, Cadre's reality is defined by record-shattering order backlogs.
And rapidly expanding adjusted EBITDA margins.
Exactly.
So let's unpack this and actually wipe away that accounting dust right now. Let's look at the actual engine of the business during their stellar second quarter of 2026.
Yeah, the mechanical variables of Q2 are staggering.
They really are. Net sales surged 31.8% year over year to $207.1 million. They crushed Wall Street estimates by $29 million.
Right, and beating consensus by that much in a mature industrial safety sector, that is not something you see every day.
I hear that, but let me play devil's advocate for you here, because we see this all the time when we do these deep dives into the source material. A company goes on a massive M&A shopping spree, they buy up a bunch of competitors, and suddenly their top-line revenue explodes.
Well, the underlying business is actually stagnating.
Exactly. Yeah. So how much of this nearly 32% surge is just them buying other companies, and is the core legacy business actually growing?
That is the perfect skeptical angle to take. To find the answer, we have to dissect the core margin expansion.
Okay, walk me through it.
So yes, they definitely had inorganic growth from acquisitions, but the organic growth, the core legacy business they already owned, hit 5%.
Which is at the absolute top end of management's targeted guidance range, right?
Exactly. The foundation isn't rotting at all.
But how do they hit the top end? Are they just, selling more units, or is something else happening mechanically?
It comes down to a highly favorable product mix and raw pricing power. On the mix side, they sold a much higher proportion of high-margin duty gear.
Like specialized holsters and tactical belts.
Right. And also these highly specialized Zircaloy robotic arms for the nuclear industry. We'll definitely get into the nuclear side a bit later.
Yeah, we definitely will. That part is wild.
But when you combine selling your most profitable items with disciplined pricing power, meaning they successfully forced price increases through to their customers to offset inflation, their gross margins expanded to 42.1%.
Wait, if gross margins expand to 42% while overall revenue is surging by almost a third, that leverage has to cascade down the income statement, doesn't it?
Oh, it drops straight to the bottom line. That operational leverage pushed adjusted EBITDA up an incredible 55.5% year over year.
To $42 million.
Right. And to put that in perspective for you, they expanded their adjusted EBITDA margins by 310 basis points.
So in plain English, their profit margin on operations jumped 3.1%.
Exactly, bringing it to an impressive 23.3%. And you have to remember, when a manufacturing business crosses that 20% threshold, it transforms from a standard factory into a highly efficient, cash-generating machine.
Okay, here is where it gets really interesting, and frankly completely contradictory for anyone who is just skimming financial news.
GAAP numbers.
Yes, the GAAP numbers. If sales are up nearly 32% and adjusted EBITDA is up over 55% to $42 million, why did the reported GAAP net income, the official legally reported bottom line profit, actually drop 6.6%?
Down to just $11.4 million.
Right. If you are an algorithm or just a retail investor reading a headline, you see profits shrinking.
And that headline risk is exactly what fueled the 40% stock drawdown. The market often trades on those optical gap misses rather than doing the actual forensics.
So how do we reconcile this dichotomy?
We have to unpack three very specific pieces of non-operational friction that drag down those bottom line figures.
Okay, walk me through the mechanics of those three frictions, because this is where the accounting really hides the truth.
So the first piece is $6.6 million in adverse foreign exchange headwinds. Cadre operates globally, right?
Right, they manufacture a lot of gear in Mexico, sell in Canada, the UK.
Exactly. And during this period, we saw wild swings in the Mexican peso, the Canadian dollar, and the British pound.
So just so I have this straight, because they're paying factory workers in pesos but reporting earnings in US dollars, a strong peso hurts them on paper.
Precisely. It creates paper losses when those foreign currencies are translated back into US dollars for their SEC filings.
Oh, right.
It has absolutely nothing to do with how many bomb suits they sold or how efficient their factories are. It is purely currency math.
Okay, fair enough. Currency swings happen to every multinational company. That explains the 6.6 million. What is the second friction dragging down net income?
This is the fascinating one, honestly. They took a $5.9 million charge for non-cash contingent consideration fair value adjustments.
Wow, okay.
Yeah, which is primarily tied to the earnouts for a company they recently acquired called TYR Tactical.
Okay, let me stop you right there and give you an analogy, because contingent consideration fair value adjustment is just a mouthful of CPA jargon.
It really is.
Think about a baseball team trading for a rookie. The deal says, we will give you $10 million now, plus a $5 million bonus if this kid hits 40 home runs next season.
Right.
Well, TYR Tactical is that rookie, and they're hitting so many home runs that Cadre is legally required to assume they will have to pay out those maximum performance bonuses.
Exactly.
Because they have to record that future bonus as a penalty against their profits today. It is quite literally a penalty for having a quote-unquote good problem.
That analogy is spot on. TYR Tactical performs so much better than initial expectations that accounting rules force Cadre to increase the liability on their balance sheet right now.
Even though they haven't paid it yet.
Right. It's a non-cash charge against today's net income for exceptional operational performance that will actually generate massive cash tomorrow.
Okay, so we have currency noise and a penalty for being too successful. What is the third piece of the puzzle?
The third piece is $2 million in inventory step-up amortization.
Whoa, hold on. Amortization. I thought amortization was for intangible assets, like, writing down the value of a patent or a piece of software over 10 years. How in the world do you amortize physical inventory, like body armor?
It's a quirk of acquisition accounting. When Cadre buys a company like TYR Tactical, the rules force them to revalue TYR's existing warehouse of inventory.
Meaning what, exactly?
They have to mark it up from what it costs to make all the way up to its fair market retail value. It's an accounting fiction where you pretend you bought their inventory at retail, not wholesale.
Oh, I see. So when they eventually sell that specific batch of acquired inventory, their profit margin on paper looks like zero.
Exactly. The cost of goods sold looks artificially high, which shrinks your GAAP net income on paper for a few quarters until that specific legacy inventory clears out of the warehouse. It is literally a phantom cost.
Okay, let me synthesize this for you listening. If we strip away the foreign exchange math, the star player penalty, and the phantom inventory accounting, what is the actual cash flow reality of this business?
The reality is that while GAAP earnings looked weak at $11.4 million, actual operating cash flow for the first half of 2026 surged 123.5%.
To $44.7 million.
Right. The business is generating mountains of cash, completely contradicting the optical GAAP miss.
But cash generated today doesn't justify a long-term hold unless you have a guaranteed pipeline for tomorrow.
Right.
if a recession hits next month, how solid is the floor under this company? Let's pivot from the cash they have today and do a strict forensic audit of Cadre's order book, because this backlog is what drives their future revenue visibility.
Yeah, and if we look at the mathematical impact, Cadre exited the second quarter with a record $367.7 million in backlogged orders.
Wow.
That backlog is up nearly 94% year to date.
They nearly doubled their backlog in 6 months. That's pushing well past $1/3 billion.
And you have to understand, this is not speculative consumer demand that just vanishes if interest rates go up. This is anchored by massive multi-year wins.
What kind of wins are we talking about?
Let's look at the specific sticky government contracts driving this. First, you have the Federal Bureau investigation. Cadre won a $61 million IDIQ contract for the FBI's overt armor kit.
Wait, I saw in the sources that they beat out 11 other competitors for this exclusive FBI contract. What is the actual mechanism there? Why did they win? Are they just the cheapest option?
Not at all. It comes down to the mechanics of Safariland's SXHP ultralight ballistic panels.
Safariland being one of Cadre's main brands.
Right. So if you are an FBI agent wearing body armor for a 12-hour raid or standoff, weight is fatigue, and fatigue gets you killed. Cadre engineered a panel that offers superior high-velocity stopping power, but at a fraction of the weight and thickness of legacy Kevlar.
Oh, wow.
They won because the technology is objectively better.
And once a federal agency adopts a specific armor platform, the switching costs, like retraining and recertification, are so high that they almost never switch, right? It just becomes the gold standard.
Exactly. Then you have the Department of War's Blast Exposure Monitoring Sensor Program, which is known as BEMO.
Okay, and what's the scale of that one?
This is a $50 million IDIQ contract for Medang, which is Cadre's explosive ordnance disposal brand. And they already have initial purchase orders totaling $18.4 million just to get started.
What does a blast exposure monitor actually do?
Think of it like a dosimeter for concussive force. Bomb disposal technicians are constantly exposed to low-level blasts. Over time, that microtrauma causes traumatic brain injuries.
Right.
These sensors measure the exact concussive wave hitting the technician, log in the data so the military knows when to pull an operator out of the field before permanent damage occurs.
That is a phenomenal piece of mission-critical tech.
Oh.
And keeping with that blast survival theme, I noticed they also secured $86.4 million in contracts with General Dynamics for vehicle blast attenuation seats.
Right. When an armored personnel carrier hits an IED, the explosive force travels straight up through the chassis. If a soldier is in a standard bolted seat, that kinetic energy shatters their spine.
Which is terrifying.
It is. So Cadre designs these highly complex, shock-absorbing seats that decouple from the floor and dissipate the blast energy.
So if we connect this to the broader thesis, these three contracts alone, the FBI panels, the BEMO sensors, and the General Dynamics seats represent nearly $200 million in highly visible, non-discretionary federal spending.
Yes.
The government does not cancel orders for spine-saving blast seats just because the stock market has a bad week.
That is the very definition of a defensive growth floor.
Okay, so we have firmly established the police and military dominance here.
Yeah.
But when you think of a tactical gear company, you think cops and soldiers. Here's where the sources get incredibly surprising.
The nuclear pivot.
Yes. How does a company that makes bulletproof vests play into the artificial intelligence boom?
I know it sounds like a massive leap, but there is a direct physical connection. It comes down to nuclear ingestion and what we call the AI power renaissance.
Walk me through how Cadre fits into nuclear power, because this was wild to read.
The Cadre Nuclear Group operates across 3 funded growth pillars. The first is national defense. The National Nuclear Security Administration, the NNSA, just submitted a $32.8 billion budget request.
Billion with a B.
Right. That is a 29% year-over-year increase purely driven by the mandate to modernize the U.S. nuclear arsenal.
That is a massive wave of capital. What is the second pillar?
Environmental cleanup. The Department of Energy has an $8.2 billion request for multi-decade remediation projects. Think of places like the Hanford site in Washington state.
The one with all the legacy radioactive waste?
Exactly. Millions of gallons of highly toxic radioactive sludge. Humans cannot go anywhere near it. You need decades of specialized containment systems and highly advanced robotic manipulators to clean it up.
Which brings us to the third pillar, and the AI connection.
Commercial nuclear energy. Surging power demands from artificial intelligence data centers are causing an unprecedented strain on the electrical grid.
Right, because training those models takes a staggering amount of electricity.
And tech companies realize that wind and solar simply cannot provide the 247 zero-carbon baseload power required to run millions of GPUs. This is driving a massive wave of commercial nuclear energy reactivations and capacity expansions.
So Cadre is essentially executing a follow-the-fuel strategy.
Yes. Wherever radioactive material goes, whether it is being enriched for weapons, stored for cleanup, or loaded into a reactor to power an AI data center, it has to be handled physically.
Right.
This perfectly positions Cadre's containment systems, their Zircaloy robotic arms, and their Wheelish-Miller manipulators to capture this robust, long-term optionality.
Wait, you mentioned zircaloy earlier. What actually is that, and why does a robotic arm need to be made out of it?
Zircaloy is an alloy of zirconium. In a nuclear reactor environment, standard steel absorbs neutrons, which makes the metal brittle and highly radioactive over time, eventually causing it to fail.
Oh, wow. But zircaloy is practically transparent to neutrons. It doesn't absorb them. So Cadre is building these incredibly high-margin robotic arms that can operate inside the core reactor environment without degrading. They provide the literal physical infrastructure required to handle the fuel.
I do want to push back here, though, because there is a specific worry floating around Wall Street regarding this nuclear division.
The downblending order.
Yes, the recent federal downblending executive order that really spooked some analysts. Basically, an order to take highly enriched uranium and blend it down with lower-grade material. Does that mandate derail this entire nuclear growth thesis?
It's a valid fear if you just read the headlines, but management swiftly clarified the math on their earnings call. That downblending executive order impacts one single container subsegment.
Just one.
Yeah, it represents less than 8% of Cadre's total nuclear revenue. It has zero structural impact on their core safety demand for defense, cleanup, or commercial power. It is a minor 8% speed bump on a multi-decade runway. Okay, so we have organic tailwinds in defense and nuclear. But Cadre isn't just riding the organic wave. They are aggressively consolidating a very fragmented safety market. Let's look at their M&A execution and their capital allocation playbook.
Because they have been busy.
Very. They've deployed $455 million across 7 acquisitions since their initial public offering.
And their approach to deploying that capital is ruthlessly disciplined. If you dissect the recent deals, you see 2 very different playbooks.
Let's start with TYR Tactical. We already talked about how they beat expectations so badly it caused an accounting penalty.
Right. They bought TYR for $185.2 million. And the out-of-the-gate outperformance is staggering, contributing $31.7 million just in Q2 revenue. But the real genius here isn't just buying revenue, it's unlocking manufacturing synergies.
How so? Like, what are they actually combining?
Cadre is taking TYR's advanced hard armor capabilities and utilizing them to build better ballistics for their own Medang bomb suits. They are cross-pollinating the tech. Plus, TYR already had deep military procurement channels in Northern Europe. So Cadre can push their legacy Safariland gear through those new European pipelines?
Exactly.
That makes total sense for a premium acquisition. But then there is the Alien Gear holsters deal. This one is fascinating because it is the exact opposite of TYR. They bought Alien Gear out of a bankruptcy court auction for just $10.3 million. Why buy a bankrupt company?
Because of ruthless efficiency, Alien Gear actually outperformed out of the gate too, bringing in $4.9 million in Q2 revenue. But the real value unlock is what I call corporate recycling. Management is executing a severe footprint optimization plan.
Meaning they're shutting down Alien Gear's factories.
Yes, they are closing Alien Gear's plant in Idaho. They are taking all the valuable intellectual property, the molds, the product lines, and consolidating production entirely into Safariland's existing global manufacturing infrastructure.
Oh, I see. So you strip out the entire overhead costs of running the Idaho facility, you fire the duplicate management, but you keep selling the product using the factory floor space you already own in Mexico or Florida. Yes. By stripping out that duplicate overhead, management expects to elevate Alien Gear's lower margins all the way up to Cadre's corporate averages over the next year.
It is a brilliant strategy. But I have to ask the critical question here. Whenever a company is on an M&A spree, deploying almost $500 million, the immediate fear for an investor is the debt load.
Right.
You do not want a company over-leveraging themselves right before a potential economic downturn. If the economy stalls, does the interest on their debt crush them?
Not here. The balance sheet remains an absolute fortress. Despite deploying $455 million, Cadre maintains a highly asset-light model. Because they consolidate factories instead of building massive new ones, their capital expenditures are consistently less than 2% of sales.
So they turn almost all their profit into free cash flow.
Exactly. And because of this strong cash conversion, they maintain a very conservative net leverage ratio in just 2.5 times adjusted EBITDA. In the corporate world, 2.5 times is highly manageable.
It gives them plenty of dry powder to go hunt for more bankruptcy deals.
Definitely. And perhaps most importantly, for your risk assessment. They have zero debt maturities until December 2029. They have completely locked in their capital structure for the rest of the decade.
Okay, we have torn through a mountain of data today. We covered the Q2 margin explosion, the optical gap mishiding massive cash flow, the $367 million record IDIQ backlog, the AI nuclear catalyst, and this ruthless M&A playbook.
It's a lot to take in.
It is. Can you synthesize this investment case for everyone listening? What is the final verdict for an allocator trying to assess CDRE?
If we pull all these mechanical threads together, we return to the core analogy. Cadre Holdings is an unassailable survivability and mission-critical backbone for global law enforcement and nuclear defense.
Right.
They operate in highly regulated, high-barrier-to-entry niches. Because they act as a non-discretionary safety compounder, meaning body armor and bomb suits must be replaced due to expiration dates, wear and tear, or regulations, regardless of what the economy is doing, current valuations represent an exceptional structural value play for allocators.
But, as we always say in Griffonomics, we must define the risk before we look at the reward. I want to make sure you know the specific execution risks that could disrupt this structural value play over the next few quarters. What are the top three?
There are three primary execution risks you must watch for. Number one, persistent foreign exchange volatility. The Mexican peso, Canadian dollar, and British pound will continue to fluctuate. If the U.S. dollar weakens or strengthens aggressively, reported GAAP earnings will bounce around, masking the operational reality again.
Okay, and risk number two is potential government procurement and IDIQ budget appropriation lags.
Right. We said an IDIQ contract is a hunting license. It is a ceiling on what the government can buy, but the actual delivery timing of those purchase orders is binary. If the federal budget stalls in Congress, or if an agency simply delays taking delivery of their armor kits by 2 weeks at the very end of a quarter, that revenue pushes into the next quarter.
Which creates an optical miss.
It creates optical misses on earnings day, even though the contract itself is totally secure.
And the third risk ties right back to our star player baseball analogy. Non-cash earnout accounting noise.
Right, because companies like TY or Tactical are outperforming, Cadre will likely have to keep taking non-cash contingent consideration hits. That means you're going to see optical earnings volatility in the quarters ahead.
You really have to be willing to look past the noisy GAAP net income and focus entirely on the adjusted EBITDA and operating cash flow to understand the true health of this business.
It requires patience.
It requires an investor to have a longer attention span than the headline reading algorithms.
Very true.
As we wrap up this deep dive into Cadre Holdings, I want to leave you with a final provocative thought to mull over. We have discussed how the AI boom requires massive data centers, which require baseload zero-carbon nuclear power, which requires Cadre's Zircaloy robotic arms to handle the fuel. But think bigger.
It is a fascinating secondary effect.
As global instability rises, and as artificial intelligence demands unimaginable amounts of continuous nuclear power over the next 20 years, could the quiet, unglamorous companies providing the literal physical safety equipment for these massive megatrends become the most valuable, unspoken infrastructure plays of the next decade?
You might not need to invent the AI to profit from it.
Exactly. You just might need to build the robotic arm that safely handles its radioactive fuel.
An incredible thought to end on.
Until next time, on The Deep Dive.